You know, um, it's a really strange thought exercise to just kind of sit back and look at what connects. Like you listening to this deep dive right now with a silk merchant walking through the chaotic halls of Renaissance Florence,
Oh, absolutely.
or even, a citizen browsing those sun-baked marketplaces in ancient Rome. I mean, we wear completely different clothes, we hold literal supercomputers in our pockets, we fly through the sky in metal tubes.
Right.
But if you lean in close enough to the historical record, you hear the exact same question being whispered across centuries. Just how do I become rich?
It is the great universal human question, isn't it?
Yeah.
And it's not just some historical curiosity or something you find in dusty old philosophical texts.
Hmm.
That exact phrase or variations of it is typed into search engines millions of times every single day,
Billions of times.
which is wild.
People are desperate for the answer, perhaps now more than ever, honestly. But we have to pause right here because there is this profound paradox at play. I
Yeah.
mean, we are currently living in the wealthiest, most technologically advanced era in the history of human civilization.
Without a doubt.
We have interconnected global stock markets. We have unprecedented instant access to the world's information. We have financial tech that lets you buy like fractional shares of multinational corporations while you're sitting on your couch in your pajamas.
It's incredible when you really think about the access.
Exactly. And yet, despite all of this infrastructure, the vast majority of people never achieve actual financial independence. Most people end up working well into their late 60s, relying on meager savings that run out far too quickly, constantly stressed, and just wondering where all that time and money went.
Yeah, and that paradox is exactly why we are unpacking today's source material. We are diving into a remarkably comprehensive, fundamentally no-nonsense document simply titled How to Become Rich.
Which is a bold title.
It is, but it operates as a complete grounded guide to building lasting generational wealth. And what makes this specific text so vital is what it deliberately leaves out.
That's right.
It completely ignores the relentless internet hype, the purposely confusing financial jargon that's really just designed to sell you things, and those exhausting get-rich-quick schemes that inevitably just leave people poorer.
Right. So if you were listening to this and feeling completely overwhelmed by the sheer volume of chaotic financial advice out there, the crypto influencers screaming on social media or the incredibly dense, unreadable retirement brochures your HR department hands you on your first day of work,
Oh, those are the worst.
they really are. And if you just want the honest, unvarnished truth about achieving financial freedom, you are in the right place. Our mission today is to extract the timeless mathematical and psychological principles of wealth. Because, as the source makes brilliantly clear right from the first page, wealth isn't just about hoarding gold coins in a vault like a dragon.
That is the perfect starting point. The text grounds this entire discussion, not with a quote from an economist or some billionaire hedge fund manager, but with a surprisingly profound insight from the comedian Chris Rock.
I love this quote.
It's so good. He said, "Wealth is not about having a lot of money. It is about having a lot of options."
Options.
Yeah.
That framing just shifts the goalpost from a meaningless number in a bank account to
Mhm.
actual agency. It's the freedom to choose how you spend your Tuesday morning.
Exactly.
It's the ability to walk away from a toxic job without instantly panicking about rent. But before we can even begin to talk about where you should put your money today, we kind of have to look backward.
We do?
We need to dissect what wealth actually is, historically speaking,
Mhm.
because the tools we use change constantly, but the underlying mechanisms, they remain shockingly static.
They're deeply consistent. If you look at the broad sweep of economic history, the story of wealth is essentially the story of whoever manages to control the era's most valuable, scarce resource. In the ancient world, the equation was brutally simple. The primary resource was land. If you controlled the fertile land, you controlled the food supply.
And if you control the food, you control everything else.
Precisely. You controlled the population, the military, the political system.
Sure, that makes sense. We think of the pharaohs in Egypt controlling the banks of the Nile, or the massive patrician agricultural estates in the Roman Empire. But the text doesn't just talk about farming. It brings up a very specific Roman figure who really understood how to manipulate the economic game of his era, Marcus Licinius Crassus.
Crassus is arguably the most fascinating case study of ancient wealth accumulation. I mean, he is widely considered the wealthiest Roman who ever lived, putting even the emperors to shame.
Wow.
But what the text highlights is that he didn't just inherit a plot of land and sit on it. He built his colossal fortune through a primitive but highly effective version of portfolio diversification and vertical integration.
Okay, break that down.
Well, yes, he owned vast tracts of real estate, but he also acquired silver mines to control the raw material of currency itself.
Smart.
And then, most notoriously, he operated a private fire brigade.
Wait, let me stop you right there. A private fire brigade. How does that even work as a business model in ancient Rome?
It was a business model built entirely on leverage and distress. Rome was a densely packed city built largely of wood, so fires were catastrophic and frequent. When a tenement building caught fire, Crassus's brigade, which was a highly trained team of hundreds of enslaved workers, would rush to the scene.
Okay, to put it out.
Well, no, they wouldn't immediately start putting out the flames. First, Crassus or his representatives would approach the desperate owner of the burning building and offer to buy the property on the spot for a drastically reduced pennies-on-the-dollar price.
That is incredibly ruthless. So it's like, sell me your house right now for 10% of its value, or I'll literally just stand here and watch it burn to the ground.
Exactly. If the owner agreed, the brigade sprang into action, saved what was left of the structure, and Crassus added another prime piece of Roman real estate to his portfolio.
And if they said no?
If they refused, the building burned, and Crassus would often just buy the scorched earth afterward for even less.
Man.
From a moral standpoint, it's completely reprehensible. But from a purely analytical, economic standpoint, the text uses Crassus to demonstrate how early wealth builders layered multiple advantages. He controlled the emergency service, the capital to buy the distressed asset, and the labor to rebuild it. He wasn't relying on just one vector of income.
He effectively localized a monopoly. Okay, so we move from the sheer brutality of land and leverage in Rome to the medieval and Renaissance periods. The game shifts, right? Land is still foundational, but suddenly commerce, trade routes, and early finance step into the spotlight.
Yeah.
The text spends a good deal of time on the Medici family in Florence.
The Medici are crucial because they represent a massive leap in financial technology. They started relatively modestly as wool merchants and textile traders,
Right.
but through managing their own complex trade routes, they realized something profound. Moving physical goods is slow and dangerous, but moving money. If you can figure out how to do that efficiently, money itself can become the product. They realized that finance could be monetized.
I've always heard they basically invented modern banking. But what does that actually mean in practice? Like, what was the actual mechanical innovation?
They pioneered a few things, most notably double-entry bookkeeping on a massive scale, but their true superpower was the widespread implementation of the letter of credit.
Okay.
Think about the logistical nightmare of international trade before this. If a merchant in Florence wanted to travel to London to buy English wool, they literally had to load heavy, highly conspicuous wooden chests full of physical gold and silver coins onto horse-drawn carts, and haul this across a continent filled with bandits, corrupt local lords demanding tolls, and perilous weather.
Which is wildly inefficient, not to mention terrifying. I mean, the risk of losing your entire net worth to a highway robbery on a dirt road in France must have been staggering.
It paralyzed trade. The friction was just too high. The Medici solved this friction. Under their system, a merchant could walk into the Medici Bank in Florence, deposit their physical gold in a secure vault, and receive a cryptographically sealed, specialized piece of paper, a letter of credit.
Right.
The merchant then travels lightly and safely to London, presents that piece of paper to the London branch of the Medici Bank, and withdraws the equivalent funds in local currency.
But wait, how did the Medici make their massive fortunes off this? Were they just charging a flat fee for the piece of paper? Because at the time, the Catholic Church had strict usury laws, right?
Yeah.
Charging interest on a loan was considered a grave sin.
You have hit on the exact genius of the Medici system. Because of the Church's strict prohibition on usury, they couldn't just charge a simple 5% interest rate. So they baked their profit into currency exchange rates.
So that's clever.
Very. The letter of credit issued in Florence was denominated in florins but paid out in London in pounds. The Medici Bank set the exchange rate, skimming a handsome, legally permissible profit off the top of every single transaction. They essentially monetized trust and geography. They created a decentralized ledger system centuries before computers even existed.
So the ruling paradigm shifts from physical land to the infrastructure of trade and capital. What happens when the timeline pushes forward to the Industrial Revolution?
The overarching theme remains the same. Control the bottleneck, but the scale just explodes. The great fortunes of the 19th and early 20th centuries were built by people who understood that machines and national infrastructure were the new path to unimaginable wealth.
Right, the Carnegies and Rockefeller.
Exactly. Andrew Carnegie in steel, John D. Rockefeller in oil, Cornelius Vanderbilt in railroads.
Vanderbilt's a great example. I mean, he didn't invent the train, but he realized that if you own the actual tracks connecting New York to Chicago, you dictate the terms of the entire economy.
Precisely. It's the concept of the toll bridge. If you own the only railroad line that a massive agricultural region can use to transport its grain to the coastal ports, you can charge a toll indefinitely. You don't have to grow the wheat, you don't have to bake the bread, you just tax the movement of the goods. They built monopolies of scale.
Which provides a perfect lens for understanding where we are today. The digital age.
Yes.
If Vanderbilt's wealth came from owning the physical railroads of iron and wood, the titans of the 21st century own the digital railroads. Information, attention, and data are the new land.
Without a doubt. Companies like Amazon, Apple, Alphabet, Meta, they have built the digital infrastructure that the rest of the world relies on to conduct business, communicate, and consume media.
Yeah, we all live on their land now.
We do, and they collect, organize, and monetize behavioral data at a scale that would be incomprehensible even to Rockefeller. And what's entirely unique about the digital age are the economic principles of network effects and zero marginal cost, which the text explores deeply as wealth accelerators later on.
Right, which we will definitely dissect.
But the overarching historical through line is abundantly clear, right? Wealth is not an accident. The wealthy possess a keen understanding of what the paramount resource of their specific era is, and they aggressively position themselves to own the choke points of that resource.
All right, so history shows us the mechanical evolution of wealth, from land to ledgers to railroads to server farms.
Yeah.
But here's a detail from the source text that honestly stopped me in my tracks.
What's that?
After walking through all this grand economic history, it points out that on an individual level, raw intelligence has almost zero correlation with financial success.
Ah, yes. It is a bitter pill for a lot of highly educated, very smart people to swallow.
I mean, it flies in the face of everything we're taught. You naturally assume the neurosurgeon, the brilliant software engineer, or the PhD economist is naturally going to be wealthy. But the text explicitly notes, you can be a literal rocket scientist and be an absolute disaster with your personal finances. And conversely, someone who barely finished high school, who works a thoroughly unglamorous job, can quietly build a multi-million-dollar portfolio. So if accumulating wealth isn't an IQ test, what exactly is it?
The fundamental argument the text makes here is that wealth creation is not primarily an intellectual challenge. It is almost entirely a behavioral one.
Behavioral.
Yes. The biggest obstacle standing between you and financial independence is not a lack of sophisticated information. Think about it. You have more raw financial data, historical market charts, and investment literature available for free on your smartphone right this second than Warren Buffett had access to during his first 3 decades of investing.
That's a crazy thought, but it's true.
The information is commoditized. The real invisible enemy is your own evolutionary biology. It is your brain.
So we are literally our own worst financial advisors.
We truly are. Our brains evolved over hundreds of thousands of years to keep us alive in a dangerous, resource-scarce environment, not to optimize a 401k over a 40-year timeline.
Yeah, fighting saber-toothed tigers doesn't really translate to index funds.
Exactly. The text dives deeply into the psychology of money to explain why smart people do mathematically stupid things. And it starts with a foundational concept from behavioral economics called loss aversion.
Okay, let's break down loss aversion, because I know this comes directly from the Nobel Prize-winning research by psychologists Daniel Kahneman and Amos Tversky.
Yes, Kahneman and Tversky fundamentally changed how we understand economic decision-making with prospect theory. Before them, classical economics just kind of assumed humans were perfectly rational actors who always maximize their utility.
Always making the logical spreadsheet choice.
Right, which is absurd. Kahneman and Tversky proved mathematically, through rigorous experimentation, that we are profoundly irrational when assessing risk. Specifically, they found that human beings feel the psychological pain of a loss approximately twice as intensely as they experience the pleasure of an equivalent, mathematically identical gain.
Okay, give me a real-world example of how that 2-to-1 ratio actually feels.
All right. Imagine you are walking down the street and you find a crisp $100 bill fluttering on the sidewalk. You pick it up, you feel a surge of dopamine, a little spike of joy. Great day, you think.
Nice. Free lunch.
But now imagine the reverse. You check your wallet and you realize you have lost a $100 bill. It slipped out of your pocket somewhere. How does that feel?
Oh, it's agonizing. It completely ruins the whole afternoon. I'd be retracing my steps, obsessing over it, feeling incredibly stupid.
Yeah.
It feels like a massive injustice, even though it's just $100.
Exactly. The joy of gaining $100 is a mild pleasantry. The pain of losing $100 is visceral distress. Evolutionarily, this makes perfect sense. In a hunter-gatherer society, if you gain an extra day's worth of food, you are discomfortably full. But if you lose a day's worth of food, you might starve to death.
Wow, so the stakes were life and death.
We are hardwired to over-index on threats. But in modern investing, this biological survival mechanism is disastrous.
Because it dictates how we react to the stock market.
Precisely. Loss aversion is the engine of panic selling. When the stock market inevitably dips and your portfolio drops by 15%, the pain of seeing that red number, that unrealized loss on your screen, is so neurologically acute that people will do anything to make the pain stop.
Just to relieve the pressure.
Yes. So what do? They sell their investments at the absolute bottom of the market. They lock in a permanent loss just to feel better in the moment. Loss aversion is also the reason millions of people refuse to invest at all, choosing to leave their life savings rotting in a checking account, earning 0.01% interest.
Right?
They are so terrified of a temporary decline that they guarantee their money will be slowly destroyed by inflation.
They completely eliminate the visible downside risk, but in doing so, they completely obliterate any chance of capturing the upside growth. It's just financial self-sabotage.
Yeah.
But the text doesn't stop at loss aversion. It pairs it with another psychological trap that I think is even more insidious, present bias.
Oh, present bias is arguably the silent killer of wealth. What it describes is the human brain's severe inability to accurately value the future. We heavily discount rewards that are far away in time, a concept economists call hyperbolic discounting.
This is the one that really hits home for me. When I try to conceptualize the 65-year-old retired version of myself, my brain just sort of short circuits. That older guy feels like a total stranger. I've never met him. He doesn't exist yet. So if you hand me $1,000 today and tell me, hey, you should lock this away in an IRA so the stranger can use it in 30 years, my brain instantly rebels. It says, why on earth would I do a massive financial favor for a guy I don't even know? I'd much rather use that $1,000 to book a vacation for myself right now.
That is a brilliant analogy, and neuroimaging studies actually back you up on this completely.
Really?
Yeah. When scientists put people in an fMRI machine and ask them to think about themselves in the present, certain areas of the brain light up. When they ask them to think about a stranger, different areas light up. When they ask people to think about themselves in the distant future, the brain lights up in the exact same pattern as it does for a complete stranger.
That is wild.
We literally perceive our future selves as different people. So naturally, sacrificing present consumption for future security feels like a bad deal to our primitive brains.
Okay, but if our own biology is actively conspiring against us, if we are wired to panic at losses and blow our money on immediate gratification, how do we possibly fight back?
The source material is unequivocal on this point. You cannot rely on willpower. Willpower is a finite, easily depleted resource. If you try to force yourself to be disciplined every single day, you will eventually have a bad day, get tired, and fail.
You just give in.
Exactly. The only effective antidote to present bias is systemic automation.
You have to build guardrails.
You have to take the decision entirely out of your own hands. You set up the plumbing of your financial life so that your savings and investments are automatically deducted from your paycheck and routed to your investment accounts before you ever even see the money in your checking account.
If the money is invisible, present bias can't touch it.
Out of sight, out of mind.
I love the mechanics of that.
Yeah.
But even if you perfectly automate your own behavior, you still have to navigate society. And the text points out that social comparison, our obsession with the people around us, might be the sneakiest wealth destroyer of them all.
Humans are intensely social, hierarchical creatures. We constantly gauge our own status and success based on relative comparisons to our peer group. But here is the fatal flaw when it comes to money. In a modern consumer economy, wealth is largely invisible. What we see and judge each other on is what people spend, not what they save.
We only see the outgoing cash flow. We see the luxury car in the driveway, the designer watch, the photos from the Amalfi Coast on Instagram. We do not see their bank balances or their credit card statements.
Exactly. And this drives the phenomenon known as the hedonic treadmill. You get a promotion and a significant raise. For about a month, you feel fantastic.
On top of the world.
But then, armed with this new income, you decide to upgrade your life. You move into a slightly nicer, more expensive apartment complex. You start shopping at higher-end grocery stores. You lease a nicer car.
Right, lifestyle inflation.
Suddenly, your peer group shifts. You are now comparing yourself to a wealthier set of neighbors. And almost overnight, your new, higher income feels exactly as inadequate as your old, lower income did. You have increased the speed of the treadmill, so you are running much faster and sweating much harder just to stay in the exact same place emotionally.
And meanwhile, your savings rate hasn't increased by a single percentage point. You've just inflated your lifestyle to consume the new revenue. The text uses this to highlight the illusion of wealth. It references the classic concept of the millionaire next door.
It is a vital reality check. The people who are genuinely accumulating significant net worth rarely look like the societal stereotype of a wealthy person. They often drive deeply ordinary, reliable cars like a 5-year-old Honda Civic or a Toyota Camry.
Yeah, boring cars.
Very boring. They live in modest, middle-class neighborhoods. They wear normal clothes. They use their surplus capital to quietly buy income-producing assets, not depreciating status symbols.
So, to put it bluntly, my neighbor, who drives that 2008 Civic, might be maxing out 3 different tax-advantaged accounts and sitting on $500,000 in index funds, while the guy 3 doors down who just leased a brand-new BMW M3 might be sweating bullets every time the mortgage payment is due, completely drowning in high-interest debt.
More often than not, that is exactly the reality. True wealth is what you don't see. It's the cars not purchased, the upgrades forgone.
There is one final psychological trap the text mentions before we get into the heavy math, and that is overconfidence. We all suffer from the Lake Wobegon effect, right? We all assume we are above average drivers, which is statistically impossible.
Right.
We also assume we are smarter than the collective wisdom of the global financial markets.
And this arrogance is incredibly expensive. The text brings receipts for this claim. It cites a massive ongoing study conducted by Dalbar Inc., which is a leading financial research firm.
Okay, what did they find?
Well, for decades, Dalbar has tracked the actual realized returns of the average mutual fund investor and compared those returns to the benchmark performance of the S&P 500 index over a 20-year rolling period.
So they aren't looking at what the market did. They are looking at what the human beings investing in the market actually walked away with. What do the numbers show?
The data is staggering. The Dalbar study consistently finds that the average investor earns roughly half the annualized return of the S&P 500 over a 2-decade span.
Half.
Let me repeat that. Half. If the market returns 8% over 20 years, the average retail investor might only capture 4 or 5%.
But wait, how is that mathematically possible? If the market goes up 8%, shouldn't the people in the market go up 8%?
You would think so, but the discrepancy is entirely due to the investor's own overconfident emotional behavior. It is the exact culmination of loss aversion and present bias. They constantly tinker with their portfolios. They read a scary headline and sell all their stocks at the bottom.
Oh, man.
Then they watch the market recover without them, get massive FOMO fear of missing out, and buy back in at the absolute peak when everything is expensive. They try to time the market. They chase last year's hot sector. They trade too frequently and rack up fees. They actively destroy their own wealth through constant emotional intervention.
Giving up half of your potential wealth just because you couldn't sit still, that is a brutal reality check. And it provides the perfect pivot point for our deep dive. We've established that human psychology makes us our own worst enemies. We panic, we inflate our lifestyles, we sabotage our returns.
Yeah.
But even if you manage to cultivate the perfect stoic mindset, it doesn't matter if your financial boat is actively taking on water. You cannot invest money you do not have.
Yeah.
So we need to move to the foundation. We have to talk about income generation, the mechanics of budgeting, and the absolute unrelenting wealth destroyer that is consumer debt.
Building the foundation is the unglamorous part of the wealth equation. It's not as exciting as talking about venture capital, exotic real estate, or AI startups. But attempting to build wealth without addressing these core mechanics is like trying to build a skyscraper on a swamp. It will inevitably collapse.
Right. And the text opens this section by throwing a harsh mathematical truth right in the reader's face. It argues that the personal finance industry has overly obsessed with frugality and completely missed the larger point. Frugality has a floor, but earning power does not.
This is a vital paradigm shift. So much mainstream financial advice is fixated on microscopic expense cutting. Stop buying the $5 morning latte, clip extreme coupons, reuse your paper
Right,
towels.
the avocado toast argument.
Exactly. And yes, minimizing senseless waste is a good habit, but if you take frugality to its absolute mathematical limit, you can only cut your expenses down to zero. That is the hard floor. You cannot spend less than nothing.
And practically, you can't even get to zero. You have to eat, you need shelter, you need healthcare.
Exactly. The effort required to squeeze the last 5% of fat out of a tiny budget is agonizing and yields diminishing returns. However, your capacity to increase your income, your earning potential, is theoretically infinite. The ceiling does not exist.
So spending hours agonizing over a slightly cheaper brand of dish soap is missing the forest for the trees if you haven't taken aggressive steps to optimize the money coming in.
Exactly. The text emphasizes that the highest return investment you will ever make, especially early in your career, is investing in your own human capital, acquiring high-leverage, high-demand skills, whether that is learning to code Python, mastering complex data analytics, or becoming an expert in digital marketing. But beyond acquiring skills, the text points out the immense, almost unbelievable compounding power of simple negotiation.
Yes. Let's drill down into the math of salary negotiation, because the numbers the text provides are genuinely shocking.
Most people view salary negotiation as a terrifying, awkward 5-minute conversation that they would rather avoid at all costs. They just accept the first offer given. But let's look at the mathematics of a young professional who negotiates just an extra $5,000 on their starting salary at their very first corporate job.
$5,000 doesn't sound like life-changing money in the grand scheme of a 40-year career.
In isolation, it isn't. But salaries are sticky and they compound. Every future raise you receive at that company is going to be calculated as a percentage of your base salary. If you get a 5% raise next year, it's 5% of a larger number.
That makes sense.
Furthermore, the anchoring bias means that every bonus, every employer 401k match, and crucially, every future job offer from competing companies will be anchored to that higher baseline.
So that initial $5,000 bump cascades through every single paycheck for the next 40 years.
Precisely. And if you take that extra $5,000 a year and instead of inflating your lifestyle, you simply invest it in a basic index fund returning 7% annually, that single, uncomfortable 5-minute conversation in HR compounds into an additional $500,000 or more by the time you retire.
Wow.
It is mathematically the most profitable 5 minutes of your entire life.
Okay, so we focus on driving the top-line revenue up. But obviously, a high income means absolutely nothing if your outflow matches it perfectly. We have to talk about how to manage the cash flow, which brings us to the dreaded B-word budgeting.
The text acknowledges that traditional budgeting is deeply flawed. It mentions the standard benchmarks, like the 50-30-20 rule, which suggests allocating 50% of your after-tax income to absolute needs, rent, utilities, groceries, 30% to discretionary once-dining out vacations, hobbies, and a strict 20% to savings, investing, and debt reduction.
That sounds like a perfectly reasonable framework. What's the problem with it?
Yeah, the problem isn't the ratios. The problem is human behavior. With a normal budget, you start the month with your paycheck. You spend money on your needs, you spend money on your wants, you inevitably encounter unexpected expenses, and you implicitly promise yourself that you will carefully save whatever happens to be left over at the end of the month.
And let's be honest, because of Parkinson's law, which says that work expands to fill the time allotted and expenses expand to consume the income available, what's left over at the end of the month is almost always zero.
Exactly. Traditional budgeting requires you to exercise massive willpower every single day on every single purchase to ensure there's a surplus left on day 30. You will fail. So the source document advocates strongly for a system called reverse budgeting. And this ties directly back to our earlier discussion about defeating present bias through automation.
How does reverse budgeting flip the script?
It changes the sequence of operations. Instead of saving what is left over after spending, you spend what is left over after saving it.
I like that.
You decide in advance what your target savings rate is. Let's say you commit to that 20%. You set up an automated transfer with your bank so that on the exact day your paycheck hits your checking account, 20% is immediately and automatically routed away. It goes straight to your Vanguard account, your 401k, or your high-yield savings.
It never even registers as available cash.
Exactly. And then, and this is the beautiful part that reduces cognitive load, you simply live your life on the remaining 80%. You don't have to meticulously track every penny on a spreadsheet. You don't have to feel guilty about buying a nice dinner or a pair of shoes because you know with absolute mathematical certainty that your primary wealth-building goals have already been met. You have paid your future self first. You bypass the need for daily willpower entirely.
It's a brilliant psychological trick. Okay, so we've maximized the income, we've automated the savings. Let's pivot to the darker side of the financial foundation, the gaping holes in the hull of the ship. Debt, but specifically high-interest consumer debt.
Credit card.
Credit cards. The text is merciless in its assessment of credit card debt. It doesn't view it as a normal part of modern life. It views it as a financial emergency. The average credit card in the current economic environment charges an annual percentage rate, or APR, of somewhere between 18 and 24%.
It is wealth destruction in its purest, most aggressive form. It is the exact inverse of compound interest working for you. It is compound interest actively working to ruin you. Let's look at the raw math. If you are carrying a $10,000 balance on a credit card at a 20% interest rate, and you fall into the trap of only making the minimum monthly payments,
Which the credit card companies are more than happy to let you do. They actually design the statements to emphasize the minimum payment.
because it is incredibly lucrative for them. If you only pay the minimums on that 10 balance at 20%, it will take you over 2 decades to pay off the debt. And over those 20 years, you will pay the original $10,000 principal plus an additional $20,000 or more purely in interest. You are effectively paying double or triple the sticker price for every pair of shoes, every dinner, every grocery run you put on that card.
And this is why the text insists you must stop investing, aside from maybe a company 401k match, until this debt is eradicated. You cannot reasonably expect to earn 8% in the stock market while simultaneously bleeding out at 20% to Visa or MasterCard. It is a negative arbitrage. You have to kill the debt.
You do, but the text is very pragmatic about how to do it. It brings up the 2 most famous, heavily debated strategies for debt repayment: the avalanche method and the snowball method.
Let's break these down because this is where raw mathematics collides head-on with human psychology, and the result is fascinating.
Let's start with the avalanche method, which is the mathematically optimal, perfectly rational choice. If you have 5 different sources of debt, you continue making the minimum payments on all of them to stay current. But any extra surplus cash you have from your reverse budget, you throw every single dollar of it at the specific debt that carries the highest interest rate.
Regardless of the total balance. So if you have a $15,000 credit card at 24% and a $2,000 student loan at 6%, you attack the 24% card with everything you have.
Exactly. Once that highest interest debt is completely eradicated, you take all the money you were paying toward it and you avalanche it down to the debt with the next highest interest rate. Mathematically, this is indisputable. It minimizes the total amount of interest you pay over the life of your debts, and it gets you out of debt the fastest. Any spreadsheet will tell you this is the right answer.
Makes total logical sense. But then we have the snowball method, popularized by figures like Dave Ramsey. And the snowball method tells the spreadsheet to go kick rocks.
It really does. The snowball method instructs you to completely ignore the interest rates. You list out all your debts from the smallest total balance to the largest total balance. And you attack the smallest balance first, even if it has a much lower interest rate than your larger debts.
Which makes the math and finance nerds pull their hair out. Why on earth would you prioritize paying off a $500 medical bill that is charging 0% interest while ignoring a massive $8,000 credit card balance that is actively compounding against you at 24%? That seems demonstrably foolish.
On paper, it is foolish, but in reality, we are dealing with human beings, not algorithms. And the text points out that behavioral economics actually heavily favors the snowball method for a large percentage of the population. Why? Because of dopamine and momentum.
We are back to psychology.
Yes. Getting out of a massive hole of debt is a brutal, exhausting, multi-year slog. If you use the avalanche method and your highest interest debt is a $20,000 credit card, you might grind away for a year and a half, throwing every spare dollar at it, and the balance only drops to $12,000. You haven't crossed anything off the list. You feel like you're making no visible progress. People get fatigued, they lose hope, and they quit.
But with the snowball method,
With the snowball method, you attack that $500 medical bill. You pay it off in 3 weeks, it is gone forever. You get to draw a thick red line through it on your list. Your brain gets a massive hit of dopamine, the neurochemical reward for completing a task. Then you attack the next smallest debt, maybe a $1,200 personal loan. You crush that in 2 months. Another dopamine hit. By engineering these early, rapid-fire psychological wins, you build massive emotional momentum.
You feel like you are actually winning the game.
Exactly. And empirical research shows that people who utilize the snowball method are statistically much more likely to actually reach the finish line and become completely debt-free. The sustained motivation they gain entirely compensates for the mathematically suboptimal extra interest they end up paying along the way. The best financial strategy isn't the one that looks perfect on a spreadsheet. It's the imperfect one that you will actually stick to when things get hard.
That is a profound takeaway. Optimize for your own psychology. Now, there is one more foundational piece the text tackles before we get into the investment vehicles, and I think this one is going to ruffle a lot of feathers. It aggressively attacks one of the most deeply ingrained cultural assumptions in modern society. The idea that renting an apartment or a house is throwing money away, and that buying a primary residence is the ultimate, unquestionable financial holy grail.
It does push back hard on this narrative, and it's necessary because purchasing a primary residence is, for the vast majority of people, the largest, most highly leveraged financial transaction they will execute in their entire lifetime. Yet the conventional wisdom surrounding it is often deeply flawed, heavily biased by the real estate industry, and passed down as gospel without critical thought.
I hear this constantly. Rent is 100% interest. Your uncle at Thanksgiving lecturing you, telling you that if you are paying rent to a landlord, you're just making someone else rich. And if you buy a house, you are building equity for yourself. It sounds incredibly logical on the surface. Where does the text say this logic falls apart?
The fatal flaw in the renting is throwing money away argument is that it relies on a false equivalency. It compares the total cost of a monthly rent check directly against the principal paydown portion of a monthly mortgage check. It completely ignores what the text calls the phantom costs of homeownership.
Unpack the phantom costs for me. Because a mortgage payment isn't just principal.
Not even close. Let's break down the true cost of owning a home. First, you have the mortgage interest. On a standard 30-year fixed-rate mortgage, the amortization schedule is heavily front-loaded. For the first 10 years of that loan, the vast majority of your monthly payment is going straight to the bank as interest. It is not building equity. You are essentially renting the money from the bank.
So in year 2 of a mortgage, practically none of your money is actually buying the house.
Correct. Second, you have property taxes. These are relentless. They usually increase over time as local governments reassess property values. And if you fail to pay them, the state will seize your house regardless of how much equity you have. Third, you have homeowners insurance, which in many regions like coastal areas or wildfire zones is skyrocketing.
But even with all that, at least the monthly payment is locked in, right? Rent goes up every year, but a fixed mortgage stays the same.
Your principal and interest stay the same, but your taxes and insurance do not. Your escrow payment can absolutely go up. But the biggest phantom cost, the one that truly drains wealth, is maintenance and capital expenditures. The text provides a sobering rule of thumb. As a homeowner, you should expect to spend between 1% and 2% of the home's total value every single year just to keep the structure standing and functional.
So on a $500,000 house, that's $5 to $10 grand a year, every year.
Yes. When you rent, your monthly rent is the maximum you will pay for housing that month. If the water heater explodes, if the roof caves in, if the HVAC system dies in the middle of a blizzard, you make a phone call, and it is your landlord's massive financial problem. When you own the house, your mortgage is the minimum you will pay that month. When the roof leaks, that $15,000 replacement bill comes directly out of your pocket.
And the text also points out the friction of transaction costs. Buying and selling real estate is incredibly inefficient.
Highly inefficient. When you buy a house, you pay closing costs, appraisal fees, title insurance. When you eventually sell, you typically pay a 5 to 6% commission to the real estate agents, plus more closing costs. Altogether, transaction costs can easily consume 8 to 10% of the property's value.
Which means if you buy a house and then get a great job offer in another city and have to sell it 3 years later, the transaction costs alone will likely wipe out any minor equity you built or appreciation you experienced. You could walk away losing tens of thousands of dollars.
Exactly. But the final and perhaps most sophisticated argument the text makes against the housing myth is the concept of opportunity cost. specifically the opportunity cost of the down payment.
This is the part that I think most people completely fail to model out. Let's say you're looking to buy that $500,000 house, and you responsibly put down 20% to avoid private mortgage insurance. That is $100,000 in cash that you have to lock up inside the drywall of that house.
Right. And that 100 grand is now effectively dead equity. It is not generating cash flow. Yes, the house might appreciate at historical rates of roughly 3 to 4% a year, roughly tracking inflation. But what is the alternative? If you decided to continue renting and you took that same $100,000 cash and deployed it into the S&P 500, historically generating a 7–10% real return, the compounding growth of that money in the stock market over 30 years will frequently outpace the net financial benefit of owning the home, especially when you factor in the saved property taxes, insurance, and roof replacements.
Now, to be fair, the text isn't saying that buying a house is universally a terrible idea, is it? It's not anti-home ownership.
It's not at all. It acknowledges the massive psychological and emotional benefits of owning your own space. You can paint the walls, you have stability for your children, you aren't at the mercy of a landlord choosing not to renew your lease, and a mortgage is effectively a forced savings plan for people who otherwise lack the discipline to invest. But the text's critical mission here is to deprogram the reader. It wants you to view a primary residence primarily as an expensive consumption lifestyle choice, not as the ultimate unbeatable financial investment. In high-cost urban markets, or if you anticipate moving within a 5 to 7 year window, running the math will often reveal that renting and aggressively investing the difference is the mathematically superior path to wealth.
It's all about looking at the cold, hard numbers, not just blindly reciting cultural catchphrases passed down by your uncle.
Okay.
So, we have thoroughly addressed the foundation. We have fixed the psychological leaks. We've optimized our earning power. We've bypassed willpower with reverse budgeting. We've destroyed our high-interest debt. And we have a clear mathematical view of our housing costs. The defensive line is holding. Our financial ship is finally watertight. Now, we have a surplus of cash every month.
Yeah.
Where do we deploy it to make it multiply?
Now we graduate to the heavy machinery. We move into the core wealth vehicles, the stock market, and real estate. And more importantly, we must dissect the mathematical fuel that powers both of them.
Let's start with the stock market. Because I think for a huge segment of the population, the stock market feels entirely disconnected from reality. It feels like a chaotic, rigged casino. It feels like a place where guys in expensive suits yell at Bloomberg terminals, gambling on arbitrary ticker symbols moving up and down based on rumors or Federal Reserve minutes. But the text makes a fundamental, almost philosophical clarification about what a stock actually is, which I think changes everything.
This is perhaps the single most important mindset shift a novice investor can make. You have to divorce the concept of the stock market from the chaotic daily lines on a chart. A stock is not a lottery ticket. It is not a blip on a screen. A share of stock is a legally binding fractional ownership interest in a real, living, breathing, operating business.
So when I log into my brokerage app and hit buy on one single share of Apple, I'm not just betting on the ticker AAPL to go up. I am literally becoming a part owner of the enterprise. I own a microscopic fraction of their patents, their supply chain, their massive cash reserves, and the physical iPhones sitting on the shelf at the Apple store down the street.
Exactly. You are an equity owner. And over the long run, and this is the key phrase, the long run, the value of that share is inextricably tied to the underlying business's ability to generate real profits and return those profits to shareholders. In the short term, over a span of days or months, the stock price is driven by emotion, news cycles, and institutional trading flow. But over a 10 or 20-year horizon, the daily price fluctuations are completely irrelevant noise. The long-term trajectory is driven by actual corporate earnings growth.
Okay, so if the goal is to own pieces of profitable businesses, how do we choose which ones to buy? Because trying to pick the next Apple or the next Amazon before they explode in value seems incredibly difficult. There are thousands of publicly traded companies.
It is incredibly difficult. In fact, it's so difficult that the text highlights a devastating reality about the professional finance industry. We are told to hand our money over to active mutual fund managers, the experts. But the data reveals a massive truth bomb. Over a 15-year period, 80 to 90% of active, highly paid mutual fund managers fundamentally fail to beat the return of the baseline market average.
Wait, I really want to emphasize this. 80 to 90%. These are people with Ivy League MBAs. They have access to massive floors of analysts, proprietary data models, and high-frequency supercomputers. And you're telling me that over a decade and a half, 9 out of 10 of them can't even beat the average. How is that possible?
It comes down to the brutal mechanics of a zero-sum game combined with fee drag. Before fees are deducted, the stock market is essentially a zero-sum game relative to the average. For every buyer who beats the average, a seller must underperform it. The aggregate of all investors is the market average. But investing is not free. Active fund managers charge hefty management fees, often 1 to 2% of your total assets every single year, just for the privilege of their expertise. Plus, because they are actively trading, buying, and selling stocks, constantly trying to outsmart the market, they rack up massive transaction costs and trigger tax liabilities.
So if the overall market naturally returns 7% in a given year and the active manager charges a 2% fee, they actually have to generate a 9% return just for the client to break even with the dumb average.
Precisely. And over long time horizons, the statistical probability of consistently making the correct stock picks time and time again, enough to overcome that massive 2% fee hurdle, drops to near zero. They're mathematically destined to underperform, which is why the source document unequivocally points the reader away from active management and toward the absolute miracle of the index fund.
Ah, the index fund, pioneered by the late, great John Bogle at Vanguard. Explain the mechanics of this because it feels like a cheat code.
It essentially is a cheat code for the average investor. An index fund does not try to be clever. It does not hire a team of expensive analysts to predict the future. It does not try to pick the winning stocks or avoid the losing stocks. An index fund, like one tracking the S&P 500, simply buys a small piece of all 500 of the largest publicly traded companies in the United States. It buys the entire basket. And because there is virtually no human analysis required, a computer just maintains the list, the fees they charge are microscopic, often less than 0.05% a year.
I've always liked conceptualizing this with an analogy. If you go to a horse race, trying to pick individual stocks is like trying to guess which specific horse is going to cross the finish line first. Maybe you get lucky once, maybe twice. But eventually you'll bet on a horse that breaks its leg and you lose everything. Buying an index fund is like deciding to just buy the entire racetrack. No matter which specific horse wins the race, people bought tickets, the hot dog stand sold food, the racetrack makes money. You are guaranteed to capture the overall aggregate growth of the American economy.
That is a brilliant way to frame it. You stop looking for the needle in the haystack and you just buy the entire haystack. And historically, capturing that overall growth is an incredibly powerful wealth engine. The text notes that the S&P 500's historical real return, meaning the return after factoring in the destructive power of inflation, is roughly 7% per year.
So the nominal return might be 10%, inflation eats 3%, and you are left with 7% real purchasing power growth.
Exactly. And at a 7% real compounding rate, your money will double in actual purchasing power roughly every 10 years. It is a slow, steady, relentless march upward.
Okay, but we have to address the elephant in the room. The chart of the S&P 500 over a century goes up and to the right, yes, but it is not a smooth, perfectly straight line. The stock market crashes. We talked about loss aversion earlier. People are terrified of market crashes, and rightfully so.
They are, and the text does not sugarcoat this reality. Crashes are an absolute certainty. The market cycle is internally driven by periods of irrational exuberance and subsequent violent panic. Look at recent history. During the 2008 global financial crisis, the S&P 500 dropped by a staggering 57% from peak to trough. During the onset of the COVID-19 pandemic in early 2020, the market plummeted 34% in just 5 brutal weeks.
If I am sitting on a portfolio of $100,000 and I log in and see it has dropped to $43,000, that is terrifying. That is visceral pain.
It is deeply painful. But this raises a crucial philosophical point that the text hammers home. These violent declines are not bugs in the system, they are features. They are the toll you must pay. The entire reason that stocks generate a 7% real return over time, which is vastly superior to the 1 or 2% you get in a safe bank account or a government bond, is precisely because equity investors must endure the psychological torment of these highly volatile periods. Risk and return are intrinsically unbreakably linked. If stocks were perfectly safe, they would offer perfectly low returns. You are being compensated for your psychological endurance.
So the multi-million-dollar question is, how do you survive the crashes without succumbing to loss aversion and panic selling at the bottom?
The text offers 2 distinct defensive mechanisms. The first is a mechanical strategy called dollar cost averaging, or DCA. This means committing to investing a fixed dollar amount of money on a rigid, unbreakable, regular schedule, completely regardless of what the market is doing or what the financial news is screaming, say $500 on the first of every single month.
So when the market is booming and sitting at all-time highs, your 500 buys fewer shares because the price is expensive. But when the market crashes 30%, your automated 500 continues to deploy, and it naturally buys significantly more shares right when everything is essentially on sale.
Exactly. You remove the burden of having to guess when the market has hit the bottom, which is impossible anyway. You just keep buying the haystack. The math is incredibly reliable. The text provides a simple projection. If you DCA just $500 a month, every month, into an index fund returning 7%, it will grow to over $566,000 in 30 years. It's not flashy, it won't make you rich overnight, but it works with mathematical certainty.
But wait, I have to challenge this slightly. It's easy to say just keep buying when we are sitting here in a calm studio. But let's go back to 2008. The banking system is literally collapsing. Lehman Brothers is bankrupt. The news anchors look like they haven't slept in days. Everyone is screaming about a second Great Depression. Am I really supposed to just blindly throw my $500 into the void? Doesn't that feel completely irrational? Like trying to catch a falling knife?
It feels terribly irrational to your biology, which is why the second survival mechanism the text offers is not mechanical, but mental. It is about internalizing the contrarian mindset of the ultra-wealthy, specifically referencing Warren Buffett. The text quotes his most famous maxim, "Be fearful when others are greedy, and greedy when others are fearful."
Greedy when others are fearful.
Yes, you have to reprogram how you view a crash. When the market drops 40%, the amateur investor looks at their portfolio, sees their wealth evaporating, assumes the world is ending, and sells. The wealth builder looks at the exact same screen, understands that the underlying companies, Apple, Microsoft, Johnson & Johnson, are still fundamentally sound, and views the crash as a 40% off clearance sale on the greatest productive assets in human history. They don't just keep buying. If they have extra cash, they buy more. They run into the burning building while everyone else is running out.
It's a profound shift in perspective.
Yeah.
Okay, so we've established the first workhorse-owning paper assets, buying fractional shares of global businesses via index funds. But the text doesn't stop there. It moves forcefully into the second major workhorse of wealth creation, and this one is infinitely more tangible. Real estate, the oldest wealth machine in the book.
Real estate is an entirely different beast than the stock market. It is fundamentally imperfect. It is highly illiquid. It requires substantial upfront capital. It requires localized market expertise. And perhaps most importantly, it requires a tolerance for the operational headaches of fixing leaky toilets, replacing roofs, and dealing with human tenants. But for those willing to engage with the friction, it offers a combination of wealth-building mechanisms that is virtually impossible to replicate in any other asset class. The text systematically breaks the power of real estate down into 4 distinct, simultaneous sources of return.
Let's walk through these 4 pillars, because I think a lot of casual observers just assume the only way you make money in real estate is by hoping the house goes up in value over time.
That is only one piece of the puzzle. Source number 1 is the most immediate cash flow. This is the operational profit of the building. It is the gross rent you collect from your tenants, minus all of your operating expenses, the mortgage payment, property taxes, insurance, property management fees, and the money you set aside for future repairs. If you collect $2,000 in rent and your total expenses are $1,650, you have generated $350 in pure positive cash flow every single month. That is immediate yield.
And I assume the sophisticated investors are heavily analyzing the debt service coverage ratio, or DSCR, to make sure the rent actually covers the debt with a healthy margin of safety.
Absolutely. A property must cash flow positively to survive downturns. Source number 2 is the one everyone is familiar with: appreciation. Real estate is a hard asset. Because the supply of desirable land is fixed, and the cost of building materials and labor constantly rises with inflation, the physical property tends to increase in value over time, serving as a powerful hedge against fiat currency debasement.
Okay, so cash flow and appreciation. Source number 3.
Source number 3 is entirely unique to leveraged real estate mortgage paydown, or amortization. Every single month, your tenant hands you a rent check. You take a portion of that check and send it to the bank to pay your mortgage. A fraction of that payment goes toward the interest, but another fraction goes toward reducing the principal balance of your loan. Over 30 years, your tenants are systematically paying off your massive debt for you. It is effectively a forced savings account, entirely funded by someone else's labor.
That is a beautiful concept. But the text really leans into source number 4. This is where the game fundamentally shifts in favor of the wealthy tax advantages.
Yes. The U.S. tax code is written by and heavily favors property owners and business operators. The text highlights one specific mechanism that feels almost like magic, the 27.5-year depreciation schedule.
Okay, I really need you to unpack this because the logic sounds completely contradictory. I buy a rental property. Ideally, I want the property to appreciate in value over the years. But the IRS allows me to legally pretend, on my tax returns, that the property is rapidly losing value.
It sounds absurd, but there is an underlying logic. The IRS acknowledges that while land does not decay, physical structures, the wood, the pipes, the roof, the foundation experience wear and tear. They degrade over time. So the tax code allows you to take the purchase price of the property, subtract the assessed value of the dirt it sits on, and divide the remaining value of the building by 27.5 years. You are allowed to take that number and deduct it from your rental income as a depreciation expense every single year.
Give me the math on this.
Let's say you buy a $300,000 rental house. The land is worth $50K, the building is worth $250K. You divide $250,000 by 27.5. That gives you roughly $9,000 a year in depreciation. Now remember, this is a non-cash deduction. You didn't actually write a check for $9,000 this year, but let's say your property generated $8,000 in positive cash flow. When you file your taxes, you subtract the $9K depreciation from the $8K profit.
So legally, in the eyes of the IRS, my profitable rental property actually operated at a $1,000 loss. I owe absolutely zero income tax on the $8,000 of cash I put in my pocket.
Precisely. You are generating significant tangible cash flow, but legally reporting zero or even negative taxable income. You can use those paper losses to offset other income in certain scenarios. You absolutely cannot do this with the dividends you receive from a stock portfolio. It is a massive structural advantage.
That is wild. But there's another massive difference between the stock market and real estate that the text highlights, and it is the ultimate double-edged sword: leverage.
Leverage is the accelerant of real estate wealth. When you want to buy $100,000 worth of an S&P 500 index fund, you generally have to deposit $100,000 of your own cash into the brokerage account. But real estate operates on debt. When you buy a $500,000 apartment building, you don't need $500,000. You go to a bank, you put down 20%, which is $100,000, and the bank loans you the other $400,000 against the asset.
That's a 5-to-1 leverage ratio.
Exactly. You are controlling a massive $500,000 asset with a relatively small sliver of your own capital, and this magnifies your returns spectacularly. Let's look at the appreciation. If that $500,000 building goes up in value by just 5% in a year, it has gained $25,000 in equity.
But since I only invested $100,000 of my own cash to buy it, that $25,000 gain isn't a 5% return. It is a 25% cash-on-cash return on my initial investment.
Exactly. The leverage amplifies the equity growth. However, the text issues a severe flashing red warning here. Leverage does not care which direction the market is moving. It magnifies losses just as violently as it magnifies gains.
Right. If the market value of that building drops by 10%, the property is now worth $450,000. It only dropped 10%. But because you only had $100K in equity, your personal equity has been crushed down to $50,000. You haven't lost 10% of your money. You have lost 50% of your net worth in a single swing.
And that dynamic is precisely what wiped millions of over-leveraged amateur investors completely out during the 2008 housing collapse. They utilized 10-to-1 or even 20-to-1 leverage, they had negative cash flow, and when property values dipped just slightly, their equity evaporated, they couldn't cover the debt service, and the bank foreclosed. Leverage is financial dynamite. It can blast a tunnel through a mountain for you, or it can blow your house up. It requires deep respect and massive cash reserves.
Now, for the people listening who hear all this and think, I love the tax advantages, I love the inflation hedge of real estate, but I swear on my life I will never unclog a tenant's toilet at 2 a.m. on a Sunday.
Yeah.
Does the text offer a compromise?
It does. It offers an alternative for the investor who wants exposure without the operational nightmare REITs or real estate investment trusts.
What exactly is a REIT? Conceptually, it sounds like a mutual fund, but for physical buildings.
That is essentially what it is. A REIT is a publicly traded corporation that uses pooled capital to acquire, develop, and manage massive portfolios of income-producing real estate. We are talking about assets the average person could never buy, individually towering apartment complexes, regional shopping malls, cold storage warehouses, and massive data centers. You can buy shares of a REIT in your standard brokerage account, just like buying a share of Apple.
But how does the tax structure work? Because if the REIT pays corporate taxes and then pays me a dividend, and then I pay taxes on the dividend, that sounds highly inefficient.
You've hit on the defining legal characteristic of a REIT. By law, to maintain their special tax status, a REIT must distribute at least 90% of its taxable income directly to its shareholders in the form of dividends. In exchange for doing this, the REIT is largely exempt from paying corporate income tax at the entity level. The tax burden is passed entirely to the shareholder.
So you get the diversification of owning hundreds of buildings. You get the robust cash flow through high dividend yields, and you have total liquidity. You can sell your shares on a Tuesday afternoon. And you never have to deal with a property manager.
Exactly. It sacrifices some of the direct leverage and personal tax benefits of owning physical property, but the trade-off in ultimate passivity is highly attractive to many wealth builders.
Okay, so we have established our two massive workhorses, the equities market and physical real estate. But what is the invisible fuel that powers both of these vehicles over the span of decades? This brings us to a concept that text reveres almost religiously, the mathematical phenomenon of compound interest.
Compound interest is the beating heart of all wealth creation. The text refers to it as the eighth wonder of the world, famously echoing a quote often attributed to Albert Einstein. But conceptually, compound interest is incredibly simple. It is the process where your investment returns begin generating their own returns. Your initial money makes a profit. Then, that new profit makes even more profit. It creates a mathematical feedback loop that starts off agonizingly slow, but eventually goes exponential, hockey sticking upward.
To really visualize this, the text provides a hypothetical scenario involving two investors, Alice and Bob. And I want to walk through this slowly because it perfectly illustrates a truth that feels completely counterintuitive. When it comes to compounding, the time you allow your money to bake is vastly more important than the amount of money you actually put in the oven.
The Alice and Bob scenario is the definitive drop-the-mic proof of starting early. Let's look at the parameters. Let's look at Alice. Alice is young, and she is disciplined early. Starting at age 25, Alice invests exactly $5,000 a year into an index fund. She does this consistently for 10 years, until she turns 35. And then, she stops completely. She never adds another dime of her own money to the account for the rest of her life.
Okay, so she invested $5K a year for 10 years. Total out-of-pocket investment, $50,000.
Correct. Now let's look at Bob. Bob is a procrastinator. He ignores his finances in his 20s. He waits until he is 35 to start investing, but Bob realizes he is behind, so he decides to go aggressive to make up for lost time. Starting at age 35, Bob also invests $5,000 a year. But unlike Alice, Bob does this every single year for the next 30 years, grinding away until he retires at age 65.
So Bob invested $5,000 a year for 30 years. Total out-of-pocket investment for Bob, $150,000. He invested literally 3 times as much of his own hard-earned money as Alice did. So obviously at age 65, Bob is going to be way richer, right?
That is what the human brain assumes. But the math of compounding defies human intuition. If we assume a constant 7% annual return for both of their portfolios, let's look at the balances at age 65. Bob, who invested $150,000 over 3 decades, will have a portfolio worth roughly $472,000.
Not bad.
Not bad. But Alice, who only invested $50,000 and hasn't added a penny since she was 35, will have a portfolio worth approximately $602,000. Alice defeats Bob by roughly $130,000, despite investing a fraction of the capital.
That honestly breaks my brain a little bit to hear those numbers spoken aloud.
Yeah.
How is that possible?
It happens because compound interest is violently front-weighted in favor of patience. The 10 years of pure, uninterrupted compounding that Alice gave her money between age 25 and 35, before Bob even started. Bob could never mathematically catch up to the sheer velocity of her early money replicating itself, even with 30 years of sustained effort. Her money had a 10-year head start to start making its own money. Time is the ultimate multiplier. The cost of waiting to invest is staggeringly high.
But the text issues a grave, flashing warning here about compounding. Just as it can work miracles for you, it can be weaponized against you. And we aren't just talking about credit card debt. The text applies the threat of reverse compounding to a silent killer fees.
The wealth management industry relies on the average person's mathematical illiteracy to extract billions of dollars. The text points out how insidious an AUM fee assets under management truly is. A financial advisor or a mutual fund will pitch you and say, we only charge a tiny 1% annual fee.
Which sounds totally harmless. If I ain't keeping 99% of my money, who cares about one little percent? I tip my barista more than that.
It sounds harmless until you apply the math of reverse compounding over a lifetime. It is not 1% of your profits, it is 1% of your entire portfolio balance skimmed off the top every single year, regardless of whether the market goes up or down. And here is the devastating part. Every dollar that is removed from your account to pay that fee is a dollar that can no longer compound for you over the next 3 decades.
It murders the exponential curve.
It decapitates it. The text provides the math over a standard 30-year investing lifetime. A seemingly tiny 1% annual fee will quietly consume approximately 22% of your final total potential wealth. If you are stuck in a high-fee mutual fund or using an expensive advisor charging 2%, you will lose almost 40% of the total wealth you could have built.
Let that sink in. Nearly half of the wealth you spent your entire life sacrificing to build. Gone. Siphoned away to pay for a fund manager's yacht simply because you didn't understand the math of a 2% fee. That really hammers home why John Bourgle's crusade for ultra-low-cost index funds changed the world for the retail investor. Keep your fees as close to zero as humanly possible, start as early as you can, and get out of the way.
Precisely. Let the math do the heavy lifting.
All right. We have covered the defensive foundation, and we have covered the steady, reliable, multi-decade workhorses of stocks and real estate. But let's say a listener sitting there thinking, okay, 40 years of index fund compounding is great for my eventual retirement, but I want to build significant wealth in my 30s or 40s. I want to compress the timeline. This brings us to the most aggressive concepts in the text, the accelerators.
The core vehicles are reliable, but they are slow by design. To accelerate wealth creation, you must step off the path of linear returns and engage with systems that offer asymmetric, exponential upside. And the source document focuses heavily on 3 primary accelerators: the technology and software revolution, entrepreneurship, and advanced tax strategy.
Let's start with the tech revolution. We briefly mentioned this during the history section, but why does the text argue so passionately that software is fundamentally different from any business model that has ever existed in human history?
To understand the unique wealth-generating power of software, you have to look at unit economics. Think about a traditional physical business. Let's say you open a highly successful gourmet bakery. You are selling out of bread every day. If you want to double your revenue, what do you have to do?
I have to double my output. I have to lease a second storefront, buy more massive industrial ovens, hire twice as many bakers, and buy twice as much flour and butter.
Exactly. Physical businesses are constrained by the laws of physics and scarcity. Your costs rise almost perfectly in tandem with your growth. But software shatters those constraints by introducing the concept of zero marginal cost.
Meaning the cost to produce one more unit is basically zero.
Exactly. A team of developers might spend $1 million in a year of agonizing labor to write the code for a new project management application. But once the code is written and sitting on a cloud server, what does it cost the company to distribute that software to one additional user? Nothing. What does it cost to distribute it to 10 million users? A few extra dollars in server space. The variable costs practically disappear. This is why successful software companies, SaaS businesses, can scale to global dominance in a fraction of the time it took industrial-age companies, and why they operate on profit margins that are historically unprecedented.
And the text pairs this zero marginal cost with another massive super accelerator: network effects.
Network effects are the holy grail of modern business modes. A network effect occurs when a product or service becomes exponentially more valuable to its users simply because more people are using it.
The classic example is the telephone. If I invent the telephone, but I'm the only person on Earth who owns one, it is a completely useless piece of plastic. It has zero value.
Right. But the moment a second person gets a phone, you have a network. By the time 1 billion people have phones, the utility is practically infinite. Look at Meta or Facebook. When Facebook was restricted to a few hundred Harvard students, it was a fun novelty. When it captured 3 billion global users, it became an invincible monopoly. Why would you ever try to start a competing social network? Even if your software is objectively better, none of the user's friends or family are on your platform. Network effects create an impenetrable fortress around a business.
But the text also makes a crucial point for the average person. You don't have to be Mark Zuckerberg to benefit from this economy. The platform economy has democratized access to global markets.
It has drastically lowered the barrier to entry. Decades ago, if you wanted to sell a product globally, you needed massive distribution networks, warehouses, and millions in marketing capital. Today, the text highlights platforms like Etsy, Upwork, YouTube, and Shopify. A woodworker in a small rural town can build a specialized product and instantly sell it to customers in 50 different countries by piggybacking on Etsy's existing global infrastructure. A talented graphic designer in Eastern Europe can freelance for top-tier Silicon Valley tech firms via Upwork. The digital platforms act as the railroad, and anyone can put their cargo on it.
And we can't discuss the digital accelerator without mentioning the massive paradigm shift that the text explicitly warns is coming, the AI wave. Large language models, generative image AI, automated coding.
The text views AI not just as a new tool, but as a historic productivity multiplier. The entrepreneurs, employees, and operators who learn how to seamlessly integrate AI to automate their coding, draft their copy, and run complex financial analyses are going to experience a massive increase in output. They are going to dramatically outpace the individuals and businesses that try to cling to manual workflows. AI is the ultimate leverage of the 2020s.
Which flows perfectly into the next accelerator, entrepreneurship. Now, the text is very clear-eyed about this. It states outright that starting a business is the highest risk path you can possibly take. The failure rates are astronomical. Most businesses die within 5 years.
It is the definition of asymmetric risk. But the businesses that do survive and find product market fit are the ones that forge the billionaires on the Forbes list. However, the document makes a really important structural distinction between two fundamentally different types of businesses that the media often conflates: the startup and the small business.
Culturally, thanks to the mythos of Silicon Valley, when we hear the word entrepreneur, we instantly picture a 22-year-old college dropout in a hoodie, raising $10 million from venture capitalists to build a mobile app, with the singular goal of going public and ringing the bell at the NYSE in 5 years.
That is the venture-backed startup path. And it is a specific, brutal game. It involves taking on external funding, which means massive dilution of your ownership. It demands prioritizing aggressive, relentless revenue growth over actual profitability. The venture capitalists know that 90% of their portfolio companies will go bankrupt, but they're hunting for the one unicorn that will return 100 times their money and cover all the losses. It is an all-or-nothing, highly stressful lottery ticket.
But the text argues that the venture path is actually a tiny fraction of the economy, and that the small business model is actually the dominant, more reliable form of massive wealth creation for the average millionaire.
Absolutely. The small business path is the wildly profitable local commercial plumbing company, the specialized boutique digital marketing agency, the niche B2B manufacturing plant. These companies might never be valued at $1 billion. They will never make the cover of TechCrunch, but they can generate hundreds of thousands or even millions of dollars in free cash flow for their owners every single year for decades. And crucially, the founder maintains 100% of the equity and total operational control. They don't have a board of venture capitalists breathing down their neck demanding hypergrowth.
And there is an incredibly overlooked subset of entrepreneurship that the text highlights, which I found totally fascinating. It's the idea that you don't actually have to endure the agony of starting from scratch.
You were referring to the search fund model or entrepreneurship through acquisition?
Yes, buying an existing, boring, profitable business.
This is a brilliant, highly strategic mechanism for mitigating the terrifying risks of entrepreneurship. Think about starting a business from zero. You face product risk. Will anyone even want this? You face market risk. Is the industry growing? You face execution risk. Can I actually build the operations? But right now, we are in the midst of a historic demographic shift known as the silver tsunami.
Millions of baby boomer business owners are reaching retirement age simultaneously.
Exactly. And a massive percentage of them own stable, highly profitable local businesses, HVAC companies, commercial landscaping fleets, specialized manufacturing lines. But their children, who grew up and went to college to become software engineers or doctors, have absolutely zero interest in taking over the sweaty, blue-collar family business. So these boomers have tracked equity and no succession plan.
So an ambitious younger person or a small group of investors via a search fund can step in. They can often utilize SBA loans, small business administration loans, where the government guarantees a large portion of the debt, allowing them to buy a $1 million business with maybe 10% down.
Precisely.
Yeah.
You step in and acquire a business that has already achieved product market fit. It already has a roster of paying customers. It already has trained employees. It already has proven cash flow. You skip the deadliest, riskiest phase of a company's life entirely. Your job isn't to invent a market. Your job is to step into the CEO role, implement modern software, optimize the marketing, and grow what already exists. It is an incredible wealth accelerator.
But regardless of how you accelerate your wealth,
Yeah.
whether you build a massive SaaS company, climb the corporate ladder to become an executive, or buy a local roofing empire, you are inevitably going to collide head-on with the single largest expense of your entire life.
Taxes.
Taxes. The text is brutally, refreshingly honest about this. You can hustle all day, you can make all the money in the world, but if you do not have a robust legal strategy to protect that money, you will hemorrhage a massive percentage of your lifetime wealth to the government. And we need to be explicitly clear here. The text is not advocating for tax evasion, which is a federal crime that puts you in prison. It is advocating for tax optimization.
Which is entirely legal and explicitly encouraged by the design of the tax code. The government uses the tax code to incentivize specific behaviors. If you do what they want, invest in real estate, start businesses, save for retirement, they reward you with lower taxes. Let's break down the basic defensive structures first. The tax advantage retirement accounts. Specifically, the fundamental difference between the traditional 401k and the Roth 401k or IRA.
This trips up so many people. They both grow your investments, but the difference all comes down to the timing of the taxation.
Exactly. It's about when the IRS takes its cut. With a traditional 401k or IRA, the money you contribute goes in pre-tax. You get an immediate tax deduction today. If you make $100K and put $10K into a traditional 401k, the government only taxes you as if you made $90K. The money then grows completely tax-deferred for decades. However, when you finally retire and start withdrawing that money to buy groceries, every dollar you pull out is taxed at your ordinary income tax rate in that future year.
So a traditional account is fantastic if you are currently in your peak earning years, sitting in a brutal 32 or 37% marginal tax bracket, and you expect to be living a simpler life in a much lower tax bracket when you retire.
Correct. You defer the tax when your rate is high and pay it later when your rate is low. The Roth framework operates in the exact reverse. With a Roth account, you get absolutely no tax break today. You pay your full income taxes on the money, and you contribute after-tax dollars. But once that money is inside the Roth wrapper, it grows completely tax-free for 30 years. And the kicker: when you retire, every single dollar you withdraw, both your original contributions and all the massive compounded growth, is 100% tax-free.
Which makes the Roth mathematically superior for a younger person who is early in their career, currently in a low tax bracket, and expects their income and the overall national tax rates to rise significantly in the future, locking in the low tax rate today on the seed so you don't have to pay taxes on a massive harvest later.
Exactly. But while the traditional and Roth accounts are great, the text reserves its highest praise for the absolute holy grail of the U.S. tax code, the HSA, or Health Savings Account.
The text calls the HSA the triple tax advantage. And it's wild because it is literally the only account in the entire tax code that operates like this. Walk us through the triple threat.
It is unparalleled. To qualify, you must be enrolled in a high-deductible health plan. If you are, the HSA offers 3 distinct layers of shielding. Advantage number 1, contributions are fully tax-deductible today, just like a traditional 401k. It lowers your current taxable income. Advantage number 2, once the money is in the account, you can invest it in the stock market, and it grows completely tax-free just like a Roth.
Okay, so it combines the best parts of both. What is the third advantage?
Advantage number 3, the withdrawals are completely 100% tax-free, provided the money is used to pay for qualified medical expenses. You avoid taxation on the seed, the growth, and the harvest.
But wait, what if I'm extremely healthy? What if I fund this account for 30 years, it grows to $400,000, and I never get sick? Is the money just trapped in there?
That is the secret backdoor kicker of the HSA that most people don't know about. Once you hit age 65, the rules change. After 65, you can withdraw the money for any non-medical reason. Buying a boat, going to Europe, paying rent without paying any penalties. You simply pay ordinary income tax on the withdrawal, just like a standard traditional IRA. So worst case scenario, it's a backup retirement account. Best case scenario, it's the ultimate tax-free slush fund for late-life medical costs.
That is incredibly powerful. But what about money made outside of these retirement wrappers? What about the millions of dollars generated by a successful business or a massive real estate portfolio? The text makes a foundational point about how the wealthy structure their income to avoid the crushing weight of ordinary income tax rates.
This is the critical divide between the working class and the wealthy class. The difference between ordinary W-2 income and capital gains. When you work a standard job, you are paid a salary or an hourly wage. This is categorized as ordinary income, and ordinary income is taxed aggressively. Depending on how much you make, the federal government can take up to 37% of your top dollars.
And that's just federal. Add in state income taxes in places like California or New York. Add in the 7.65% FICA payroll taxes for Social Security and Medicare. And a high-earning W-2 employee is easily losing close to 50% of their marginal income to the government.
It is the most highly taxed form of money in existence. But the wealthy do not derive their wealth from a W-2 salary. They make their money by holding assets. And in the United States, if you buy an asset like shares of a company or a piece of real estate or an entire business and you hold it for longer than 1 year before selling it, the profit you make is no longer classified as ordinary income. It is classified as a long-term capital gain.
And the tax brackets for capital gains are completely different.
Vastly lower. Depending on your overall income level, long-term capital gains are federally taxed at 0%, 15%, or a maximum of 20%. So to put this in perspective, a highly skilled surgeon making a massive salary might be bleeding out 45% of her next dollar to combine taxes. Meanwhile, a business owner who sells a piece of commercial real estate they've held for 5 years will only pay 15 or 20% on the massive profit.
The system is explicitly designed to reward the providers of capital and the owners of assets, while heavily penalizing the providers of labor.
Exactly. The text also touches on business structuring, specifically mentioning the S corporation designation for self-employed entrepreneurs. This is another classic optimization technique.
Right. If I am a sole proprietor, a freelance consultant making $150,000 a year, the IRS hits me with a 15.3% self-employment tax on every single dollar of that profit on top of my normal income tax.
Yeah.
That's devastating.
But if you structure that exact same business as an S corporation, the rules change. You are required to pay yourself a reasonable W-2 salary from the business, say $70,000. You pay the 15.3% payroll tax on that $70K. But the remaining $80,000 of profit can be taken out of the business as a shareholder distribution. And shareholder distributions are completely exempt from that 15.3% payroll tax.
So just by filing a piece of paper with the IRS and changing how the money flows from the business to my personal bank account, I legally save over $12,000 a year in pure taxes.
Every single year. It is all about playing the economic game by the rules that are explicitly written to favor ownership, equity, and strategic investment.
Okay. We have covered a monumental amount of ground. We built the defensive foundation. We invested in the long-term workhorses of equities and real estate. We explored the super accelerators of tech, small business acquisition, and tax optimization. What is the ultimate point of all this effort? Where is the finish line? This brings us to the final act of the text, the end game. The concept of passive income and the deeper mindset of the wealthy.
The end game, the true definition of financial freedom as presented by the source, is the permanent severing of the link between your time and your income.
I have to pause and push back here because this is where my alarm bells start ringing. The phrase passive income. Honestly, when I hear passive income, my brain instantly conjures up those incredibly scammy, aggressive internet marketers on YouTube standing in front of a rented Lamborghini trying to sell me a $2,000 course on dropshipping. It feels like a total myth designed to fleece gullible people. Is passive income actually real, or is it just a marketing buzzword?
The text acknowledges your skepticism head-on. It agrees that the term has been deeply corrupted and weaponized by internet hustlers. But if you strip away the hype and the rented Lamborghinis, the underlying economic concept is genuine, mathematically sound, and absolutely essential. To explain it, the source leans on Robert Kiyosaki's famous cash flow quadrant framework.
Break down the quadrant for us.
Imagine a square divided into 4 sections. On the left side of the quadrant, you have employees E and self-employed individuals S. The defining characteristic of the entire left side is that these people are trading their finite time for money. If an employee gets sick and runs out of PTO, the paycheck stops. If a self-employed dentist decides to take a month off to travel, the clinic generates 0 revenue. Their income is linearly chained to their physical presence.
Okay, so what is on the right side?
On the right side, you have business owners B and investors I. The defining characteristic of the right side is that they own systems and assets that generate cash flow completely independent of their daily physical labor. A true business owner has hired a CEO and a management team to run the operations. The owner just collects the profits. An investor owns real estate or stocks that pay out dividends. If the investor spends all of Tuesday sleeping in a hammock, the assets still generated money. True financial freedom is the agonizing multi-year process of migrating from the left side of the quadrant to the right side.
Okay, so if we discard the scammy, make money clicking buttons internet courses, what are the actual legitimate forms of passive income detailed in the text?
The purest, most frictionless form is dividend investing. You amass a large portfolio of shares in massive, highly profitable blue-chip companies, and every quarter those companies deposit a portion of their corporate profits directly into your checking account as a dividend.
But the math on this requires a massive runway, right? The S&P 500 historically averages a dividend yield of around 1.5 to 2%. So if I want to live off dividends and I need $50,000 a year to live, I need, what, a $2.5 million portfolio?
Exactly. It is entirely passive. You do absolutely zero work to collect the dividend. But the barrier to entry is immense. The accumulation phase takes decades. The second form of passive income is real estate cash flow. But as we discussed at length, being a landlord is a highly active, stressful second job. To make real estate truly passive, the text notes you must hire a professional property management firm.
Which is going to eat up 8 to 12% of your gross rental income right off the top.
Yes. But this is a trade-off that many wealthy investors gladly make. They willfully accept a lower overall yield in exchange for buying back their time and sanity. True passivity has a cost.
And the third category of passive income is the modern one, the one that the internet actually gets partially right: digital products and intellectual property.
This is where the concept of zero marginal cost returns. Writing a book, recording a comprehensive digital training course, coding a software plugin, or even writing a hit song. You put in a massive, unpaid, active amount of effort up front. The work is heavily front-loaded. But once the asset is created and deployed onto digital distribution platforms, it can generate royalty or licensing income indefinitely while you sleep. The active work happens once. The passive income trails behind it for years.
It's a marathon, not a sprint. But none of these mechanics, not the index funds, not the real estate, not the tax codes, matter if the human operating the machine is broken. Which leads us into the final unifying piece of the puzzle, the invisible engine driving all of these strategies, the psychological mindset of the wealthy. Because you can hand someone a perfect optimized portfolio, and if they don't have the right mental frameworks, they will panic and lose it all.
Mindset is the operating system, and the text synthesizes a few key philosophical frameworks that the ultra-wealthy share. The first is a subtle but profound shift, treating your personal life as if it were a formal business.
Meaning what exactly? Running quarterly earnings calls for my family.
Not quite that extreme, but conceptually similar. It means you apply the same rigorous, dispassionate analysis to your personal life that a competent CEO applies to a corporation. You actually track your income and granular expenses. You calculate your personal net worth and look at your own balance sheet. Most importantly, you evaluate the return on investment for your major life choices. If I take out $80,000 in student loans for this specific master's degree, what is the realistic bump in my earning power, and what is the ROI timeframe? It is a shift from being a passive, emotional consumer of your own life to being the active, analytical executive of your financial future.
And part of being a good executive is managing your supply chain, or in human terms, your network. The text spends time on the network effect of people.
It's not what you know, it's who you know. We usually say that cynically as a complaint about nepotism, but the text frames it as a beautiful reality knowledge travels through relationships and massive opportunity flows exclusively through trust.
Right, because the best opportunities in life, the unlisted executive job openings, the invitation to invest early in a brilliant startup, the introduction to a fantastic real estate deal, these things never appear on a public job board or a Zillow listing. By the time they hit the public market, the real value has been extracted. These asymmetric opportunities travel strictly through private, trusted networks.
Exactly. So the wealthy deliberately and constantly invest in relationships. They make introductions for people without expecting an immediate return. They add value to others' lives, knowing that over a long enough timeline, the network effect of goodwill compounds into massive serendipity.
That tracks perfectly. But my absolute favorite mindset piece in the entire document, the one that I think is the most actionable, is the relentless focus on continuous learning.
It is the single most consistent behavioral trait among self-made billionaires.
The text notes that Warren Buffett spends up to 80% of his working day sitting alone in a room, just reading. Reading thick, boring annual reports, financial newspapers, and biographies. Bill Gates famously takes multiple think weeks every year where he isolates himself in a cabin with a massive stack of books on new technologies and global health just to absorb new ideas.
They do this because knowledge, much like money, aggressively compounds. When you learn a foundational mental model or a historical truth today, it acts as a hook. It makes it easier to understand and contextualize the next new piece of information you encounter tomorrow. In a global economy that is shifting radically due to AI, globalization, and technological disruption, any static set of skills will eventually become obsolete. The ability to continuously learn, unlearn, and adapt is vastly more valuable than whatever degree you earned 20 years ago.
I love the quote the text drops in here from, of all people, Dr. Seuss. It says, the more that you read, the more things you will know. The more that you learn, the more places you'll go. It's written for a kindergartner, but it operates as the foundational thesis for navigating a complex global economy.
It is undeniably true. And the final mindset principle ties this entire multi-hour discussion together. It is the core muscle you must build delayed gratification. The entire premise of building wealth is the systematic, repeated choice to favor the security and freedom of your future self over the fleeting desires of your present self.
But, and I think this is where the text sticks the landing beautifully, it clarifies that delaying gratification does not mean living a miserable, deprived, ascetic life today. It doesn't mean eating rice and beans for 40 years and never taking a vacation.
Right. It goes back to reverse budgeting and automation. You set up the mechanical system so that your investing and your delayed gratification happen automatically in the background. Once the future is funded, you are entirely free to spend whatever surplus is left over joyfully, guilt-free, on things that bring you actual happiness in the present. It is the ultimate alignment of human behavior in cold mathematics.
Okay. Let's pull the camera all the way back and bring this all together. We have covered a staggering amount of technical, historical, and psychological ground from this document. From the ruthless fire brigades of Rome to the tax efficiency of the modern HSA. But if there is a singular, unified summary of the core message here, it's this. Building wealth is not about possessing an overnight stroke of genius. It is not about timing the market perfectly. It is certainly not about hitting a lucky bet on a meme crypto coin.
It is none of those things. True wealth generation is the boring, beautiful, relentless accumulation of unglamorous choices. It is the discipline to maintain a surplus, the wisdom to buy productive assets instead of depreciating liabilities, the vigilance to minimize the destructive drag of fees and taxes, and the profound patience to step back and let time do the heavy lifting of compounding.
The source ends with a fantastic quote from Napoleon Hill that I think captures the necessary urgency perfectly. Start where you stand, and better tools will be found as you go along. You don't need to know the intricate nuances of the tax code to begin. You just need to begin.
But before we officially sign off, I want to leave you, the listener, with a final provocative thought to mull over. Something that builds on the mathematical principles we have discussed today, but steps outside the realm of finance entirely. We have spent an hour talking extensively about how compound interest works for your money and how starting early front-loads massive exponential returns. But compound interest is not just an economic concept. It is a universal law of nature.
Okay, where are you going with this?
Ask yourself this question today. What non-financial areas of your life are currently suffering from present bias? What about your physical health, your closest relationships, your professional skills? These things compound exactly like an index fund. A small neglect in your diet or your exercise routine today doesn't hurt much right now. It feels fine. But compounded daily over 20 years, it leads to devastating, irreversible health crises. A neglected relationship slowly decays over time until the trust is entirely bankrupt. So, what is the one investment, a difficult conversation you need to have with a partner, a physical habit you need to start, a new technical skill you know you need to learn that you are putting off today simply because of present bias, that will cost the future version of you an absolute fortune and happiness 10 years from now?
Wow. That is going to stick with me. The cost of waiting isn't just measured in dollars and cents. It's measured in the life you could have lived. So as we wrap up today's deep dive, Think back to that silk merchant in Florence or that citizen whispering in the marketplace in ancient Rome asking how to be rich. They didn't have Vanguard index funds. They didn't have global internet access or 27.5-year depreciation schedules. But you do. The tools, the mechanics, and the options are sitting right in front of you. The question isn't how to do it anymore. The question is simply whether you will choose to start. Take your first step today. We'll see you next time.